Michael Saylor is an American entrepreneur, executive chairman of strategy, and one of the world's most prominent advocates for Bitcoin.
Strategy filed an 8K with the SEC disclosing that they sold 3,588 Bitcoin last week for $216 million. Now, that is by far the biggest sale in the company's history, but let's keep it in perspective. They're still holding 843,775 Bitcoin, and they're sitting on $2.55 billion in cash. It looks like the knee-jerk reaction to the sale took Bitcoin down to 61K, but by midday we were back above 63K and the 200-week moving average. STRC has clawed its way back to $90, and MSTR is now above $100.
Everyone thought this Bitcoin sale was a sign of surrender, but the deeper you look, the more it starts to resemble one of the smartest financial moves of the year. What if the biggest Bitcoin sale of the year wasn't actually bearish? At first glance, that's exactly what the headlines wanted you to believe. But once you dig into the numbers, a completely different story begins to emerge. Bitcoin's price may swing wildly, yet the conversation suggests those short-term moves are distracting investors from what truly matters. Instead of reacting to volatility, the focus shifts toward long-term capital allocation and financial strategy. The most surprising detail is that while attention centered on a single Bitcoin sale, the company had already purchased tens of thousands more throughout the year. That means every Bitcoin sold was outweighed many times over by new accumulation. So why sell it all? The answer wasn't fear, it was financial engineering. By realizing a tax loss, improving liquidity, reducing debt exposure, and improving access to capital during a difficult market, the company strengthened its overall position without abandoning its Bitcoin thesis. That's the distinction many investors miss. Looking only at transactions without understanding their purpose creates a misleading narrative. In cryptocurrency markets, context is often more valuable than headlines. Price fluctuations attract attention, but balance sheet management, institutional confidence, and disciplined capital allocation often reveal the real story. Sometimes a move that appears bearish on the surface is actually preparing for the next bullish chapter. Everyone saw the Bitcoin sale. Almost no one understood what was really happening. Stay until the end, because the numbers reveal a strategy that could completely change the way you view institutional Bitcoin investing.
What happened last year? What happened with the price
It goes
last
up and
year?
it goes down, but it's irrelevant because the point is it's going up at double to triple the rate of the S&P over the long term because it's economically superior.
People shouldn't panic if it loses 50% of its value. Is that the crypto winter?
No, the
Is
right
that
way to
over?
think of it is people shouldn't invest in a volatile capital asset. If you want to make a capital investment in anything, real estate, equity, Bitcoin, you should have a time horizon of 4 to 10 years. If you need the money in the next 4 months, you're a credit investor.
But
Well,
I just want to.
if you're going to ask me the question, you got to listen to the answer. The point really is Bitcoin is the world's most secure digital property network. It's 21 million blocks. It's the cyber Manhattan. So all of the people in the world that would like to put their money in a bank in cyberspace, they don't trust the government. They don't trust a company.
5 weeks ago, Strategy sold 32 Bitcoin, and people melted down about it for a solid week. So you'd think a sale 112 times bigger would break the internet, right? Instead, the panic barely made it to lunch. That difference is telling you something important, and we'll come back to it. In Q2, Strategy bought 85,296 Bitcoin and sold 3,620. For the year, that's roughly 175,000 bought against 3,600 sold. That's a ratio of 48 to 1. For every 1 Bitcoin that went out the door this year, 48 came back in. Calling that a seller is like calling a guy who saves half his paycheck broke because he bought groceries. And the entire week-long sale was about 1% of a single day's Bitcoin trading volume. And here's the detail the media skipped over this morning. Strategy sold these coins at an average price of $60,000. Their cost basis is around $75,500. So they deliberately locked in a $55 million loss. Now, why on earth would anyone do that on purpose? Well, it's called tax loss harvesting. Back in October, S&P Global gave Strategy a B- credit rating. And buried in the report, they spelled out exactly what it would take to get upgraded. 3 things. Improve your dollar liquidity. Reduce your convertible debt. And prove you can still access capital markets during what they called, quote, a Bitcoin stress. In other words, the S&P handed Saylor a checklist. So watch what he's done since. Dollar liquidity, he built a $2.5 billion cash reserve from nothing. Convertible debt, he's bought back $1.5 billion of it. And access to capital markets during a Bitcoin stress? Well, we're currently living through a stress test. A brutal bear market, maximum fear, and Strategy raised money, paid every dividend, and for the first time ever funded all 5 of its preferred by selling Bitcoin, without touching a dollar of that cash reserve. This sale wasn't aimed at you. It was a message addressed directly to the ratings agencies. The machine works even when Bitcoin is bleeding. This is the road to a better credit rating.
What if the next Bitcoin bull run doesn't begin with a price surge, but with a financial strategy that almost everyone misunderstands? Stay with us, because what looks like an ordinary corporate decision could be the biggest clue to Bitcoin's next historic move. What if the secret behind Bitcoin's biggest corporate buyer isn't simply buying more Bitcoin, but knowing exactly when to sell a small portion? That is the deeper message behind this discussion. Instead of viewing every Bitcoin sale as a bearish signal, you are encouraged to examine the broader capital strategy driving those decisions. The conversation explains that a Bitcoin treasury company survives by maintaining confidence across both credit and equity markets. Without investor trust and continued access to financing, large-scale Bitcoin accumulation becomes impossible. That transforms occasional Bitcoin sales from a sign of weakness into a financial tool designed to strengthen liquidity, meet obligations, and preserve future buying power. The discussion also expands beyond cryptocurrency by questioning traditional stores of wealth, such as real estate, arguing that many investors rely on property because fiat currencies steadily lose purchasing power. Perhaps the most compelling takeaway comes from Bitcoin's market cycle itself. Rather than viewing the 2021 rally as a genuine reflection of demand, the argument suggests it was inflated by excessive leverage and failed crypto firms. If future institutional capital enters a market with Bitcoin's permanently fixed supply, the next major rally could be driven by genuine adoption instead of speculation, creating a fundamentally stronger and potentially historic bull market.
Company, and what we do is we sell credit. We sold $10.5 billion of STRC. We bought $10 billion of BTC, of Bitcoin with it. And our credit investors expect that we're going to support the credit dividend and pay it, and our asset is BTC. So they expect, they're like, are you willing to actually, if you make $1 trillion and you owe us some money, will you sell some Bitcoin to pay us the money? They expect me to say yes, because if I'm not going to pay the dividend, they won't buy the credit. The credit rating agency won't rate the credit, right? The equity investors, they bought a company that's stacking Bitcoin. They expect us to say we're going to defend the equity and we're going to run the company responsibly. So if a short seller shorts the stock to a 90% discount to the Bitcoin NAV, they expect us to defend the stock and swap the Bitcoin for the equity so they don't get abused. Confidence of the capital markets, we're buying 0 Bitcoin. And so what the company is doing is rational, and it's in the best interest of the credit markets, the equity markets, and also the Bitcoin market, right? Because like, how is Bitcoin better if I don't buy 175,000 Bitcoin? So, in fact, I don't think there's a conflict between doing the right thing for Bitcoin, doing the right thing for the equity, and doing the right thing for the credit. I think that those are all in a very comfortable harmony, in a dynamic harmony with each other. That's why our company went from a $600 million enterprise value to an $85 billion enterprise value.
He told you the plan, just watch 20 years of savings disappear. That's China's real estate market, adjusted for inflation, back at 2006 levels. And this wasn't a stock market for them. Chinese households keep an estimated 60 to 70% of their wealth in property. The national savings account just round-tripped to 0 gains in 20 years. Saifedean Ammous put it bluntly this weekend. If you think home prices crashing is bad, you have fiat brain. Homes are consumer goods. The cheaper they get, the better. You only treat a house as an investment because your money is broken and you have never known real savings. And before anyone says this is a China problem, American home sellers outnumber buyers by 630,000 right now, the widest gap ever recorded. A house is a thing Bitcoin runs since 2021. And honestly, from my perspective, 2021 even barely counts. That top was manufactured by paper leverage via frauds like FTX, 3 Arrows, and Terra Luna. These were casinos stacked on top of Bitcoin. And the casinos burned down. Everything since has been a part of the long hangover. Meanwhile, silver and gold went absolutely vertical in 2025. Two hard assets with far bigger supplies and slower adoption curves went parabolic the moment real capital flooded in. Now think about what happens when that same wave reaches an asset with a totally fixed supply. The moment capital starts flowing back in and the world realizes the debasement trade was never over, it was just on pause, Bitcoin begins its next parabolic run. And with this little supply meaning that much trapped money, I think it'll be one for the history books. And we can actually measure where this run would be starting from. There's a metric called the realized price. It's the average price every Bitcoin last moved. So think of it as the cost.
So, what if the biggest catalyst for Bitcoin's future isn't tomorrow's price chart, but the financial decisions happening behind the scenes today? That's the question worth asking. While most investors chase headlines and panic over short-term volatility, the real signal may be hidden in how institutions manage capital during uncertain markets. If companies continue protecting liquidity while steadily increasing Bitcoin exposure, could that be laying the foundation for the next major rally? And if institutional demand keeps growing while Bitcoin supply never changes, what happens when those two forces finally collide? History suggests markets often move long before the crowd realizes what's happening. The next explosive phase may not begin with hype. It may begin with disciplined accumulation that few people notice. The only question left is whether the market is underestimating what's quietly unfolding. Let us know your thoughts in the comments. And don't forget to like, share, and subscribe for more crypto market analysis. So, what do you think? Are institutions quietly preparing for Bitcoin's biggest breakout yet? Or is the market missing a hidden risk? Share your opinion in the comments below. And if you enjoyed this analysis, don't forget to like, share, and subscribe for more deep dives into the world of crypto. Do you believe Bitcoin's next bull run will be driven by institutional investors or retail investors?